Okay, good evening. This is our lecture video number 3. And for this video, allow me to give you some reminders and pointers regarding our topics, starting with joint and byproduct costing. So, of course, as a result of joint processing, the cost incurred from the start of the process up to the split-off point, which is the joint cost, is to be allocated only to the main products or joint products. Main products are the very reason why we engage in a joint processing. Although incidental outputs like byproducts, scrap and waste may result in a joint processing, they are not to be allocated with the joint cost. Of course, waste has no value at all. They are to be discarded. Scrap normally are treated as other income. Byproduct are recognized either upon production or upon sale, depending on if the byproduct is significant or insignificant. So when the byproduct is recognized upon production, it is said to be that it is significant. The usual treatment is the NRV of the byproduct is a deduction from joint costs before allocating the joint cost to the main products. Otherwise, if the byproduct is insignificant, it's the recognition is upon sale. NRV is either a deduction from CGS, an addition to sales, or other income. In allocating the joint cost to the main products, joint costs are allocated either using physical measurement, which is unchanging yardstick, and the monetary measurement, which is the changing yardstick. Between the two, it is said to be that monetary measurement is more accurate because it considers the revenue generating capability of the units. When you say monetary measurement, it can either be sales value at split off, number of units times the selling price at split off. The NRV at split off, it's the number of units times the selling price at split off minus end disposal cost at split off. And the approximated or the hypothetical or the estimated NRV, which is the final selling price less any further pricing costs, which is true if there is an incremental profit or incremental revenue is more than the incremental cost. So that's it for the joint and byproduct costing. Then we proceed with the job order cost flow. So when you say job order costing system, costs are accumulated according to jobs. So normally the usual questions involving that situation is the statement of cost of goods manufactured and sold, starting with the raw materials inventory beginning plus raw materials purchase equals raw materials available for use minus raw materials at the end is equal to raw materials use, which may include direct and indirect materials. So simply remove the indirect material use. Then from direct materials use plus direct labor plus overhead as applied with the assumption of normal costing. We use a predetermined overhead rate in estimating or applying overhead to production, after which we arrive at total manufacturing cost. From total manufacturing cost, we add the work in progress beginning, put into process, minus work in progress at the end, CGM. From cost of goods manufactured, we add finished goods beginning, available for sale, and minus finished goods at the end, CGS, at normal costing. So close any over or under applied depending if the over or under applied is immaterial or material. Then if in case immaterial, the over applied is to be deducted from CGS only. Otherwise, if under applied, to be added. Then if in case it is material other than CGS, we prorate the over or under applied to CGS, finished goods inventory, and work in process inventory. Take note also of the entries. Excuse. Upon purchase of materials, we debit raw materials inventory and credit accounts payable if on account. Upon issuance to production, we debit work in process as to direct materials, we debit factory overhead control as to indirect, and credit raw materials inventory. For labor distribution, we debit payroll or salaries and wages as we credit accrued payroll or salaries and wages payable. Then we distribute the amount, we credit payroll, we debit work in process as to direct labor, and we debit factory overhead control as to indirect labor, and operating expenses in general for the period cost. Then the last element of cost is of course the overhead, which will be debited to work in process and credit overhead as applied. Then the total amount debited to work in process is said to be the TMC. Then as we credit to work in process, we debit finished goods inventory, representing the cost of goods completed during the period or during the year, which when added with the finished goods beginning, the cost of goods completed last period or last year, is the available for sale. Credit finished goods inventory, it means cost of goods sold, so debit CGS. And again, take note of the overhead actual and the overhead applied for purposes of the disposition of any over or under applied overhead, which will be close to CGS, again if yung material, then from CGS at normal costing to CGS at the actual costing, or CGS for income statement purposes. Then we review the process costing, take note of the cost of production report, the quantity schedule in particular, units in process beginning, add units started in process if in department 1, otherwise units transferred in if in department 2, equals units to be accounted. Then as accounted, assuming the method which represents more accurately the physical flow of units, which is FIFO, the units transferred out will be detailed, dissected between those units coming from the in-process beginning, which entered production last month, and the units which entered production this month, or the units started in process. After which, we also account for the units in process at the end, followed by the lost units, which if be within expectations, again normal, otherwise beyond expectation, abnormal. So all in all, the units as accounted, and in that particular column is the physical units or the whole units or the actual units. Then we prepare the equivalent units of production or the measurement of work done in terms of units, wherein if ever FIFO, we consider what was done last year, the fraction or the percentage or the units completed last period or last month, because we only consider the work done this month in terms of preparing for the equivalent units of production, which will serve as the denominator, as well as the numerator, which is the cost incurred this month. So for the units which started in production this month, also were completed this month, as to materials and as to labor, 100%. As to the units in process at the end, we consider as of end of the month, if it is based on the percentage of work done or percentage completed or percentage converted, we find out as to materials to what extent were already added for the month for the units in process at the end. So let's say materials are added at the start of the process, or materials are added at the start, then by a particular stage of production for the units in process at the end, then materials are already 100% complete. Otherwise, conversion costs are of course assumed to occur evenly throughout the process. So be very careful in terms of the EUP, which will be used as a denominator in computing for the unit costs for purposes of computing for the cost of units transferred out as well as cost of units in process at the end. Take note of the lost units, in particular the normal loss units, which after giving those normal loss units its own cost, we therefore allocate, if only units in process at the end are already good units, we allocate the normal loss units its cost between the transferred out and the in process at the end. Otherwise, if the in process at the end units are not yet inspected, then all the costs of the normal loss units are to be absorbed only by the transferred out units. I also want to remind everyone regarding, of course, about home office and branch accounting. Take note that the allowance for overvaluation before adjustment is the markup on the goods available for sale of the branch to the extent of the merchandise coming from the home office, of course. When you say allowance for overvaluation after adjustment, required balance, adjusted to, downward to, it is again the markup on the ending inventory of the branch to the extent of those merchandise coming from the home office. And of course, it is also known as the after adjustment. So before adjustment, after adjustment, again, it is the realized markup, which is the adjustment, the amount which is debited to allowance for overvaluation in the books of the home office at the end of the year, as the home office credits income summary branch to make the net income of the branch, as far as the branch is concerned, from being understated to true income. Take note also of the working paper entries. For the reciprocal accounts, one of the entries in the working paper is to debit home office current and credit investment in branch to eliminate the reciprocal accounts and not extended on the combined statement of financial position. We also debit the allowance for overvaluation as we credit beginning inventory to eliminate the allowance account partially to the extent of the markup on the beginning inventory, as well as to make the beginning inventory of the branch from at bill price at cost for combined FS purposes. One of the entries also in the working paper is to eliminate shipments to branch by debiting the account, eliminate shipments from home office by crediting the account, and at this point, we eliminate completely the allowance for overvaluation, which we debit as we close the two reciprocal accounts in the income statement. And the last working paper entry is to debit ending inventory and credit ending inventory, debit ending inventory as to income statement, and ending inventory credit in the working paper as to balance sheet. So that would be all for now, and see you again for the next video. Good night.